This is Market Minute, the weekly brief. I'm Marcus. Before we start, the usual. This is a recap for context, not financial advice. The story of this week is a story about a piece of paper that stopped being worth anything. 3 weeks ago, the United States and Iran signed a memorandum of understanding to reopen the Strait of Hormuz and wind the war down. Markets treated that document as a promise. Oil fell. Inflation fears cooled. Investors started building portfolios on the assumption that the worst was behind them. By Wednesday, the president had declared the ceasefire over. American forces were striking Iran's coast for the second night running, and that assumption was gone. That single reversal is the thread running through everything else this week. It runs through the oil market, obviously, but it also runs through the Federal Reserve, which released minutes showing a committee that has quietly stopped talking about cutting rates and started talking about raising them. It runs through the airlines, the steel mills, and a small cap rally that almost nobody is paying attention to. 6 stories. Let's get into it. The market spent this week arguing with itself. The Nasdaq finished Thursday at 26,206, up about 1.5% on the week. The Dow finished at 52,487, down about 0.8%. Same 5 days, opposite directions. That gap tells you what investors were pricing. Anything plugged into the artificial intelligence build-out kept working, because demand for chips and data centers does not much care what happens in the Persian Gulf. Everything else, the industrials, the energy-sensitive names, spent the week getting shoved around by headlines out of Ankara and Bandar Abbas. Wednesday was the ugly day. Trump declared the truce with Iran over, fresh strikes followed, and the Dow dropped 577 points in a single session. The Nasdaq, remarkably, closed that same day slightly higher. 2 different economies, trading in the same building. Then Thursday arrived with a hint that Iran might be open to ending the fighting, and everything snapped back. The Nasdaq rose 1.3%, the S&P 500 0.8, the Dow 0.3. A week that felt like chaos ended up, on the scoreboard, as a shrug. The takeaway is not the percentage, it is the mechanism. This is now a market where one sentence from a podium moves a 500-point index either way, and where the AI trade is the ballast holding the whole thing steady. That is a strength. It is also a concentration risk, and we will come back to it. Here is how the truce actually fell apart, because the sequence matters. Iran attacked commercial vessels near the Strait of Hormuz. The United States responded on Tuesday by pounding sites along Iran's coast, and, in the move that mattered most to markets, revoking Tehran's ability to sell oil legally. That is not a military strike. That is a supply strike. Then on Wednesday, Trump said the ceasefire was over and American forces went back in. Crude did what crude does. It jumped 5.2% on Wednesday, the steepest single-day move since May, closing above $73 a barrel after starting the week under 69. By Thursday, with peace signals back in the air, it eased to 72. The uncomfortable detail is what America has left in the tank. The Strategic Petroleum Reserve, the cushion the country draws on when supply gets disrupted, is now at its lowest level since 1983. That surfaced this week as a warning, not a headline. If this conflict truly reignites, the buffer is thin. There is a smaller story worth knowing if you own airlines. Jet fuel is down 40% from its April peak, and fares have not budged. Carriers raised prices when fuel spiked and never gave the money back. And with Spirit gone, they do not have to. Delta and United both hit record highs. That is the shape of an energy shock in 2026. It does not hit everyone equally. It transfers. If you only pay attention to one thing from this week, make it this. The Federal Reserve released the minutes of its June meeting, the first under new chairman Kevin Warsh, and the tone has changed in a way that should reset a lot of assumptions. Officials broadly agreed they would need to raise interest rates if inflation stays elevated this year. Not pause. Raise. The projections make it concrete. 9 of 18 participants penciled in at least one rate increase by December. In March, that number was 0. Only one anticipated lower rates, down from 12. Rates have sat at 3.5 to 3.75% since December, and the committee's own arithmetic flipped from easing to tightening in a single quarter. What changed? 2 things. And one of them will surprise you. The first is energy, because a war in the Gulf pushes fuel costs into everything. The second is artificial intelligence. Fed officials are now naming the AI investment boom as a genuine source of persistent inflation. The spending surge on data centers and computing power is demand the economy is straining to supply, and that strain shows up as prices. This is a real shift in how the central bank thinks. A year ago, it could call a tariff-driven price increase a one-off and let it pass, because the labor market was soft enough to justify patience. Now hiring has steadied, and cost pressure is arriving from two directions at once. Its preferred inflation gauge has been running near 4%. The one thing arguing for calm is jobs. June payrolls came in softer than expected, which gives the doves something to point at. The committee meets July 28th and 29th. Between now and then, they get June consumer prices. Watch that print. Now the story almost nobody told this week. The most interesting rally in the American stock market is happening in companies you have never heard of. The Russell 2000, which tracks smaller companies, climbed roughly 22% in the first 6 months of the year. That is its best first half since 1991. It beat the Nasdaq Composite by around 9 percentage points, the widest gap since 2006, and at one point last week it notched 4 straight record closes. The reason they came back is mechanical. These companies earn most of their money at home and having less access to capital markets than multinationals. They borrow at rates that move with the Fed. When the market believed rate cuts were coming, small caps were the highest leverage bet on that belief. There is an earnings story underneath it too. Analysts project 54% earnings growth for Russell 2000 companies in 2026, more than double what is expected for large caps. But hold that against what we just heard from the Fed, because these two stories are on a collision course. This rally was built on cheaper borrowing. 9 Fed officials now expect the opposite, and a chunk of the gain came from chip names like MaxLinear, up more than 600% last quarter, meaning even this is partly an AI trade in a different costume. One number for scale. Every company in the S&P Small Cap 600 added together is worth about $1.83 trillion. That is roughly the size of Broadcom, one company. If even a sliver of mega-cap money rotated down here, it would move these stocks enormously. The AI story stopped being a software story a while ago. This week it became unmistakably an industrial one. Samsung projected a 19-fold surge in second quarter operating profit. That is not a company riding a trend. That is a company that cannot make memory chips fast enough. SK Hynix kicked off a United States listing seeking $28 billion in fresh capital. And Apple said it plans to spend more than $30 billion with Broadcom over the next 5 years on American-made chips. Then the story I find most revealing. American steel makers are having a very good year, and the reason is data centers. All that construction needs steel. But the industry spent this week warning that it is now competing with its own customers for electricity. Mills need power. Data centers need enormous power. The people selling the picks and shovels are in a bidding war with the miners. That electricity squeeze is the same physical constraint the Fed just wrote into its minutes as an inflation risk. Same phenomenon. Two institutions describing it from opposite ends. One narrative shift worth flagging. A year ago, executives said AI would wipe out jobs. This week, the message has softened to something else. Workers keep their jobs and get a productivity boost. Whether that is true or just what you say when the political weather changes, I will leave to you. Every week I look for the thing that is not going well, because a market this concentrated cracks somewhere, and the crack usually shows up in private markets first. This week it did. The slice of private software debt trading below 80% of its original value hit a 5-year high last year, according to MSCI. It peaked at 6.1% at the end of September, roughly 5 months before software stocks began falling on worries about AI tools. The credit market saw it first. It usually does. The consequence is showing up in private equity. Buyout firms are sitting on a backlog of portfolio companies they cannot sell, and it is getting worse because nobody is sure what AI does to a traditional software business. If you cannot tell whether a product gets commoditized by a model in 3 years, you will not pay last year's price for it. In public markets, the froth took 2 haircuts. SpaceX joined the Nasdaq 100 and promptly fell 6.8% on its first day in the index, closing below the price where its shares began trading in June. And Rivian lost 18% after disclosing plans to sell stock, which is the market's blunt way of saying it does not enjoy being diluted. None of this is a crisis. It is a pattern. Money that flowed into anything with a growth story is starting to ask harder questions, and it is asking them of the private, illiquid, expensive stuff first. The deal market is wide open, and the deals being done tell you what boards are afraid of. Fifth Third is buying Comerica, another chapter in the consolidation of American regional banking, where scale has become the only reliable defense. In Europe, EasyJet soared nearly 10% after agreeing to a $7 billion takeover by Castlelake. Getty Images called off its merger with Shutterstock after a British regulator dealt the deal a blow. And Hugo Boss asked its own shareholders to reject a $2.2 billion bid from Fraser's Group. The one that should worry you is media. The combined Paramount and Warner Brothers Discovery is arriving with nearly $80 billion in debt. That is a number with consequences. It presses down on content spending, streaming investment, news operations, sports rights. When a company is built out of a debt pile that large, the debt starts making the creative decisions. On policy, a quietly fascinating one. Large American banks have been exploring an acquisition that could let them get around the law they hate most, the cap on fees they earn on debit card transactions. That is a multi-billion-dollar revenue line. If a structure exists that legally sidesteps it, expect it to be used and expect a fight. And in crypto, the Trump family venture that channeled more than $500 million to the family is in talks to sell its core business to a blockchain company called Perpetuals.com. File that under things to watch, not things to act on. So where does that leave us? A war that restarted, a Fed that stopped talking about cuts, an AI build-out big enough to show up in the inflation data, and a small cap rally built on a rate assumption that may have just expired. Here is what I am watching. First, the June consumer price report. It lands before the Fed's July 28th meeting, and after those minutes, it is the most consequential number on the calendar. Second, whether the ceasefire holds because, with the Strategic Petroleum Reserve at a 1983 low, America has less room to absorb another supply shock than it has had in 40 years. And third, the small caps. If they keep climbing into a hawkish Fed, the earnings story is real and not just a rates bet. As always, this was a recap for context, not financial advice. Do your own work and size your positions like you might be wrong. If this was useful, subscribe. It is one video a week, and it is all you need to know what actually happened. I'm Marcus. This has been the weekly brief from Market Minute,